Property prices have boomed in 2023, but will the Reserve Bank's next move potentially cause it to come crashing down? That's what we're going to explore in today's video. Specifically, the price rises this year. Prices have gone up for 9 consecutive months this year, and they've risen by 8.9% since the trough in February.
Now, looking at the monthly gain in October, 8 capital cities were up by 0.8%. Year to date, since February, dwelling prices are up a staggering 8.9%. And that's all going on with so many rate rises, property prices are still increasing.
It's kind of a double-edged sword. It's good news, obviously, if you're a home buyer, you've bought the last couple of years, but it's not great news if you're looking at getting the market. So what does the future hold? What does the crystal ball say? Well, I guess let's look at the causes and what's been behind this and what potentially might impact the price in the future. So the major things, there's 3 things that have been driving the price growth. The first is the population growth into the country. We've had more people come here, over 500,000 in the last 12 months. It's set to continue for the short term. It should temper out the next 2 years, but that's definitely caused a shortage in the market.
Now, the other thing is a rental shortage. There's fewer vacant homes available to rent, which makes it more expensive for renters, effectively pushing people into purchasing property that might not have already been wanting to get into the market.
And the third, really the X factor, is the sale to foreign buyers. The sale to foreign buyers has reached a 5.5-year peak, causing a bit of a shortage because you're competing against a bit of an unfair playing field. People have got cash and don't necessarily need finance.
Now, looking at the Reserve Bank of Australia, it's expected that they will need to raise the cash rate soon. And this might affect market sentiment, especially after the raises we've seen in property prices in the short term. This will also affect those that already have mortgages, as when rates go higher, it becomes more expensive for those homeowners that have already borrowed the money.
But the data is still showing some pretty positive signs. Westpac's MI House Price Index actually went up in October, which suggests people are still thinking prices are still going to continue to rise into the calendar year next year.
And even when we look at the regional areas, prices have increased in regional Australia, although slightly less than capital cities around Australia. If you do find value in this video, please consider hitting that subscribe button, as it does really help out the channel. And a big thank you to all our subscribers for your support. Inspires us to create more content we hope you enjoy. Now, Jaden, let's have a look at each of the capital cities and have a bit more of a detailed analysis of the price rises in October. Starting with Sydney, they had price rises of 0.8%. Looking at Brisbane, 1.4% increase on prices month to date, which is a crazy increase. Brisbane really seeing some solid growth, and Adelaide and Perth having increases of 1.3% and 1.4% respectively.
Yeah, houses saw a bigger gain, 1% compared to units, which rose by 0.7%. And we've seen this on the ground a bit, where a lot of our home buyers, it doesn't matter pretty much which city you're in Australia at the moment, it's been tough. You're competing against investors, in particular. Our Perth home buyers are really struggling, where you used to be able to get a home for $500,000 within sort of 45 minutes of the city. And it's getting tougher and tougher because you've got all these investors coming over from the East Coast, from around Australia. It said, well, I can buy an investment for 500 grand. I've got land. I can rent it out for a pretty good yield. So there is that market where it is tricky to get your first home in there, and you need to put some of the strategies, which we've covered in other videos, into place.
Now, although house prices have had a 1% increase in comparison to units at 0.7, we have started to see a lot of home buyers choosing to go for units, mainly because of the affordability. We've had 12 rate rises in the last sort of 18 months, and that affordability piece has really come down. So we have seen a bit more of a popularity for units, not for anything, for the fact that the affordability with higher rates is something that a lot of first homeowners are choosing to opt in for.
Interestingly, with units, something that has come up and been a bit of a focus for banks, as a bit of an aside, is the strata cost and the body corporate cost. So when you are looking at this, people are a lot more focused on these extra costs that come with owning a home, and it's not just a repayment, which as a mortgage broker, we can help you with factoring that in.
Now, new listings have been 12% higher compared to this time last year. Now, the numbers are still low comparative to a 5-year average, but we are still starting to see a little bit more stock available out there, where maybe about 6 months ago, a lot of our customers were really struggling to get into the market to find property just because there was really no stock available.
So moving forward to the Reserve Bank and what's going to happen there, a lot of economists are saying that the push is coming to shove and they're potentially going to have to move. After 12 months, there's been a few months of pauses there. It's looking like the Reserve Bank may need to adjust the cash rate up. Now, it is a bit of a sort of give and take situation, where the Reserve Bank doesn't want to sort of stretch it like a rubber band too hard, because if it pulls too tight, then it's going to come back and snap a little bit harder. So if they go too hard on interest rates, it can cause the economy to slow down. It can cause jobless rates, unemployment to grow, because employers say, well, I can't afford to keep people on. less people have jobs, less people can afford their mortgage, and it has a concertina effect across the economy.
And they've talked about this as a lag effect, which is the difference between when they make a decision on the rate rise and when it actually comes through and trickles through to the economy. Some say it can take 18 months for that lag effect to fully permeate through to the economy. There's also still 2 million fixed rate customers that are coming off their fixed rates. So they're going to have a massive rate shock when they're coming off their low 1.99% fixed rate, because a lot of people did fix in for 4 years, roll off to that, and maybe they're on 6%. That's going to have huge consequences to affordability.
Yeah, the majority of these people, though, I guess the counter to that point, have come off their fixed rates. They started maturing earlier this year from fixed rates from 2020 that matured over the last 2-3 years. So we've found a lot of people that have come off that were fortunately ahead in their repayments. Their home values have gone up a lot as well, so they've been able to manage that, but potentially have to cut back on some discretionary expenses. So if you'd have your fixed rate coming up, hit us up. We can look at reviewing that, potentially negotiating with the existing bank, or look at a new bank if it makes sense to do so.
Now, recent data from the Australian Bureau of Statistics showed higher than expected inflation rate, which was 1.2% higher at 5.4% for the September quarter. This has put mounting pressure on the Reserve Bank and their requirement to get that inflation back down to their target of 2 to 3% within a timely figure to really move in the November's board meeting to increase the cash rate by 0.25%, which would bring the official cash rate up from 4.1% to 4.35%. So it is looking very likely that we're going to have a rate rise, and November seems the month, because if they wait till December, that might have a huge impact on the retail sector. The retail sector at the moment is already screaming out saying we're really struggling. Any more rate rises is going to stop people from spending. And as we get closer to Christmas, I think the Reserve Bank really has little choice but to move in November.
So bringing it all together, a recent survey of economists still tipped property price growth next year, even with interest rate rises. The real pressure from migration from overseas, from the limited new supply of stock coming in, from overseas buyers coming to the market, and just housing affordability with rents going up, it's going to push more people into the owning market. So there still is scope for growth. It's crazy to say, even though we're at peaks again of median house prices across Australia, with employment rates still pretty low, it still looks like things are looking pretty positive for the market in 2024.
And I think coupled with that, the rate of new builds is at an all-time low. We're not seeing the construction levels anywhere near the supply demands. So that's also going to have a knock-on effect, because when there's not enough new supply coming on the market, the demand's relatively high. It's going to have an artificial sort of inflation on the market and property prices in the near future. In terms of rates and how many more rate rises are expected, Jen, what do you think is going to happen to the market? It's looking likely for a rate rise in November. We've got a few people out there saying, how many more rate rises are there?
Yeah, it's the economists are really split on this, because it depends on all these factors that have suddenly come into play. The fuel prices, the issues in Ukraine and Israel that are putting pressure on oil prices, and that comes over here. That affects energy, petrol, that sort of thing. And also, as the interest rates go up, it makes the landlords put up their rent, which causes this cycle that we're starting to get in. So they're trying to nip it off now and slow things down. So a lot of economists are pretty split. They're saying 1 to 2 more rate rises at the moment. We're seeing that reflected in the fixed rates at the moment. Say just really roughly, the variable rates are around 6%. The 1 to 2 year fixed rates are around sort of 6.5%. Some are a little bit lower, but they're potentially pricing in 1 to 2 rate rises in the short term. But then beyond that, it's hard to say. There's still economists saying that there could be rate cuts later next year. It depends on all these factors, because if they see unemployment come off, then the Reserve Bank's going to have to act quickly, stabilize the economy, cut the rates and sort of spur on some growth. But if prices keep going up, if spending keeps going up, then they're going to potentially have to cut the rates to increase the rates rather, to slow things down.
Now, guys, here at Hunter Galloway, we're a mortgage broker. We deal with people Australia-wide. So if you need assistance, hit us up at huntergalloway.com.au or call us directly on 1300 088 065. Guys, as always, thanks for watching, and we'll see you next time.